Hello, everyone. Nick Ryder here with another edition of Kathmere's Charts of the Month. Investors have endured their share of financial panics over the years, including the recent swath of regional bank failures earlier this year. None of it compares, however, with the full-scale meltdown that markets witnessed 15 years ago this month. Friday, September 15th marked the 15-year anniversary of the trigger of it all, the bankruptcy filing of the once proud investment bank Lehman Brothers. Shown here on the screen is a front page from the Wall Street Journal on Monday, September 15th, 2008, the day after attempts to broker a solution to save or sell the investment bank broke down. The American financial system was shaken to its core, the journal's front page article began. The New York firm was far from alone in crumbling under the pressure created by a loss of confidence in complex derivatives bets and subprime mortgage bonds. Over the same weekend, Merrill Lynch agreed to be bought by Bank of America, and one of the world's biggest insurers, AIG, scrambled to raise cash to shore up its balance sheet. The turmoil and negative headlines continued through the week, ultimately culminating in the U.S. government seizing control of AIG and announcing a series of interventions seeking to stem the crisis. For investors, the week of September 15th, 2008, and the months that followed were undoubtedly frightening. From the close on the Friday before Lehman collapsed to its low nearly 6 months later on March 9th, 2009, the S&P 500 ultimately declined 46%. Throughout the last few months of 2008 and into the early part of 2009, many were left wondering how long it would take, if ever, for the stock market to recover. We, of course, know today that the market would ultimately recover and ultimately do so perhaps a lot quicker than many anticipated at the time. Here we present what I consider to be fascinating data covering the S&P 500's cumulative total return in the years following Lehman's collapse. We can see that 1 year later, the index was still modestly underwater to the tune of 14%. 3 years later, it had fully recovered its losses and was slightly positive by 3% total. 5 years later, it was up 52% in total, or nearly 9% per year. 10 years after Lehman's collapse, the S&P 500's total return was 186%, or more than 11% per year. And here in September 2023, fully 15 years later, the S&P 500 is up more than 380% in total, or 11% per year. In my perspective, it's truly remarkable to see that in the 10 and 15 years following the bankruptcy of one of Wall Street's most storied investment banks and the onset of a truly global financial panic, that the S&P 500 would go on not only to deliver positive returns, but above average returns. Above all else, I believe this look back provides a valuable reminder to us all as investors of the importance of maintaining a long-term perspective and practicing discipline and patience in the face of the inevitable episodes of market turmoil we'll all experience through our investing journeys. That's all for this month. Thanks for tuning in, and we'll see you next month.